I did not hit record.
Yeah, I
I
love
did
it.
not. I did not hit
Do
record.
that again.
Oh yeah, do that again. Yeah.
That's so me and Matt all the time. Like
Yeah.
you're doing it, right? No?
Yeah.
Okay.
It's like, did you read anything about school? No. Didn't you? No, no, I deal with sports. You deal with school. He forgets that part of the conversation.
I love it. All right.
Go ahead.
No, seriously.
Okay.
Okay.
Welcome to the Doctors Building Wealth podcast. Today, we're really excited to have Amanda Hahn and Matthew McFarland. They are Keystone CPA. Sorry, let me do it again. Welcome to the Doctors Building Wealth podcast. Today, we're really excited to have Amanda Hahn and Matthew McFarland joining us. They run Keystone CPAs. They are best-selling authors. We love chatting with them because we always have so much fun, and they give so much phenomenal information that's really digestible about how to save on taxes using real estate investing. And today we're going to be focusing on some interesting ones, how to save on taxes with real estate investing and not have use a short-term rental tax loophole or real estate professional. So we're really excited to have you guys. Welcome.
No, thanks for having us, guys. Look forward to it.
Yeah, excited to be here and talk about how to offset W-2 income with real estate. I think that's always top of mind for so many people.
Yeah. So before we dive into ways that you can shelter income other than real estate professional status and the short-term rental tax loophole, can you just briefly talk about those two ways of using, those people call them loopholes or really the tax code, tax incentive that's been created to allow you to shelter your income?
Yeah, I mean, if you are a real estate investor and if you or a spouse is a real estate professional, then the benefit is that when you strategically create tax losses, it doesn't just offset rental and passive income. It also offsets all income sources. We typically use W-2 as an example, but it also offsets income from gain on sale of stocks or crypto or retirement distributions, right? And so the beauty of real estate professional status for long-term rental investors is now we open up the kind of the whole closet to say, okay, rental losses now just offset all different types of income, including W-2.
Yeah, and that can work very same way for short-term rentals. So if people are investing in short-term rentals, self-managing, putting in enough time to kind of meet their qualifications, it also can help use those strategically created losses on the short-term rentals to offset all types of income, business income, W-2 income. So it can be a pretty powerful strategy for sure.
Yeah, a really valuable strategy. A lot of people in our community have been using both of those.
Yeah, and we also used it not only, when we were physicians to shelter our W-2 income, but then also to shelter our business income from semi-retired MD. And maybe you guys can quickly mention about the difference between how much you can shelter of your W-2 income versus 1099 or business income.
Yeah, it definitely can be different. So I mean, thanks to tax changes that came out a few years ago, they put a cap on how much W-2 income by itself you could offset. It's around, give or take $600,000 for a married couple. But yeah, if you have a business, they treat business income like, you got an operating practice of some kind. And real estate, if you or your spouse be a real estate professional, they treat those as, basically business activities for both. So there's really no limit per se. It's almost like you could have $3 million of business income. If you buy enough real estate, theoretically, you could offset it all.
It's just like another example of how the tax law favors, right, real estate investors and business owners. Like I can't think of any rhyme or reason as to why we decided to limit how much W-2 income we can offset. But nonetheless, that's kind of the current law as it stands. There is with proper planning, we have had clients sort of overcome that limitation. If you can plan a couple years in advance, because what happens is, let's say that I have, $1 million of W-2 income and I have $1 million of rental losses. So whereas Matt said I can offset maybe 600 roughly of W-2 income, then I have these $400,000 of losses. And a lot of times clients wonder, like, what happens to that? Do I just lose it? Where does it go? And the good news is that loss then just turns into a net operating loss. And so fast forward to the second year, that $400,000 loss can offset W-2 income. That is not subject to the loss limitations as you normally would have. So when we have clients that are like, I don't know, looking at large W-2 income from, some company going public or whatever, a lot of times we have to plan for those things a couple years in advance. And when you do that, then it gives you like the optimal tax savings.
Yeah, I just want to clarify then for people who are real estate professional 1 year and they create this $1 million of losses, even if they only use 600,000 that year, the 400,000 that carries forward remains active losses, so it can shelter W-2 income the next year. And so I just want to make sure people hear that, so they're not thinking that it turns passive the next year when they don't have real estate professional, for example, stays active. Cool.
Yeah, regardless of their status the following year. That's a pretty cool thing.
Mm-hmm. So Matt kind of alluded to it. Part of what we wanted to talk about here was medical office. And you just talked about the situation where somebody, maybe the spouse has real estate professional, the other spouse is working full-time, they have a medical office, and they can shelter that medical office income using real estate professional status and those strategic losses. But what about if nobody has real estate professional? Can we talk about how you potentially could shelter medical office income using real estate?
Yeah, that's a great question because I know you guys do too, and we have a good number of clients who are kind of in that field. They're buying buildings because they're in the real estate industry, right? They're starting to kind of, hey, it makes sense, instead of paying rent, I'm going to buy my own, office building and use it for my practice. And in situations where maybe they're the only, there's a couple things that come to my mind. We can talk about. The easiest one is, if the only tenant is themselves and they've bought it in the same entity as your practice, which has its pros and cons, it's not necessarily that's the way to do it. But if you did it, then you could definitely use the depreciation to offset the active income because it's all in the same tax return. So not really any issue there. But what you'll see more people doing, which I'm sure you guys are seeing too, right, is they're buying in, you got the medical practice in one entity and you've got the office building in another, because for asset protection reasons, right? The lawyer wants to separate the two kind of assets, if you will. And that's what we're seeing. It takes a little bit of planning ahead, but there's definitely ways that you can create those strategic losses like we talked about in from the real estate and still use it against the building income without being a real estate professional.
Yeah, I mean, typically what we do on the tax return is you make an election to group those activities together. So that even though they're technically in two different entities for asset protection purposes, you're treating them as one activity for tax purposes. And so with that grouping election is what allows you to be able to, do accelerated depreciation, take bonus on all the furniture and all that, and then being able to use the tax losses to offset not just the rental income that you pay yourself, but also just the active income from the business operation. So in our example, the actual medical practice itself. And that's true regardless of whether you or a spouse is a real estate professional. We see this a lot with clients, especially when it comes to physicians, because you don't find a lot of physicians that are like, hey, I went to school for all these years and now I just want to give all that up and do real estate full time and become a property manager, right? We have a lot of people who are still building that medical practice, but they do want to get some benefit. They want to start getting into real estate. And that makes a lot of sense too, because you already have your built-in tenant as well.
So what happens in the situation where your losses exceed your medical practice income? What happens to the excess losses?
Yeah, I mean, if you do this grouping election, and your medical office, your medical practice, say, is an active activity because you're there every day, you're running the business. That loss becomes an active loss that you can use against W-2, 1099, whatever other types of income you have. And that's the beauty of it without being a real estate professional.
I will say, I don't think we've actually seen that in practice. For the most part, in that example, maybe the medical practice was not doing so well to begin with, right? Typically, what we see is that it's reducing the income, and we still have some kind of positive income on the medical side. Another thing, just like a small tip, is because you have your rental in a different entity, right? One of the things is to consider maximizing the amount of rental income that you pay to your rental LLC. there's not any income tax savings associated with it, but the benefit is that if I'm able to carve out more of my profit on the S corporation side, then it might be easier for me to make an argument that I should take a lower salary, right? Lower payroll. And the payroll part is what I'm saving roughly up to 15% taxes on. So just something simple to do, right? Instead of paying myself the lowest rent, I want to try to pay myself the highest so that I can lower my,
Highest reasonable rent, right? Yeah.
yeah, so I can lower my payroll and save a little bit more on taxes too.
And that's really important for people to hear because sometimes people are going and buying a medical practice and it comes with the building. And what they're seeing is the old tenant, was paying a really high rental rate to the medical office building as a rent. And they're wondering, is that like actually, a reasonable rent? Is that a rent that I could get if I, moved offices and had somebody new rent this office? And it's not necessarily so. So you want to make sure you're still checking out what is the rent in this area, what's market rents, and not just assuming that what the owner is paying is actual market rent, because they might be doing what you're talking about. They might be paying a little bit higher so that they can have less S Corp income and be able to kind of shift it. Really, it's just shifting expenses, right?
Yeah, one bucket to the other, right? But
Yeah.
I think it's worth noting too, is in order to kind of, we were talking about this grouping election, right? In order for that to kind of work, the IRS basically says you can do that when there's kind of what do you want to say, like enough ancillary connections between the two businesses. So, you've got the same owners, same ownership percentages, sharing office space, sharing overhead, that kind of thing. It doesn't work as well if you are in two different locations and you've got different staff. There's definitely rules you have to meet, but in the right situation, it works really, really well.
Yeah, I think a common one would be like if I own the medical practice, but my building is owned, 10% by me, 90% by somebody else.
Yeah.
That's where it could be problematic to make the grouping because it's no longer kind of like the same. You brought up the concept of, doctors buying up medical practices that come with the building. So another tip would be, on the acquisition of any business, we always want to look at purchase price allocation, right? Which is to say, I'm paying $5 million. What is that made up of? And how do I allocate it so that I can get the most tax benefit? How much to equipment, how much to the real estate versus how much to, goodwill, right? Of the customer list, or I don't know if you call it patient list, that I'm buying from the previous owner.
Yeah. So you really ideally have the maximum for the real estate because that's going to allow you the depreciation compared to the buying of the medical office operations, right? Is that kind of what you're saying?
Well, I mean, probably more so to, I would say, equipment, furniture and equipment, right? Because those you could maybe take 179, you could take faster depreciation on it. And then thereafter, yeah, maybe real estate if you can do cost segregation and, extract out the benefits from there.
Yeah, this is really helpful for people to hear because what we've had instances where our students will buy the property and have the property in an LLC for asset protection, and they'll have the operations in a different LLC, and their CPAs will tell them they can't do anything to shelter taxes, but they wanted the asset protection. So it just goes to reinforce how important it is to have a CPA who actually understands this, actually does this, because these kind of decisions really should be planned ahead of time, actively along the way. You don't want to just build everything and then go find your CPA and say, hey, this is what I've done. You could actually create it in a very tax efficient way upfront if you had a great CPA who you were working with.
I was gonna say we've kind of seen a negative impact sometimes when somebody will buy, let's for example, the building inside of the operating business, because most operating businesses are going to be corporations, right? If they're doing tax planning correctly, it's going to be a C corp or S corp. And so if you buy a rental property, commercial building inside of it, and you have loans, oftentimes the tax losses are limited when it gets to your personal tax return, which is one of the reasons we always say don't buy rentals in S corp, right? Because S corp laws are just different. When I'm using leverage to buy real estate, my ability to take a deduction might be limited if it's not funded by my money. And so we've seen, unfortunately, seeing that bite people in the butt. So just be really careful of that. The age-old message of don't buy rentals in S corporations, don't buy it in C corporations. Be aware and think about that before you buy a medical building. Because like you said, I think a natural inclination is to say, it's for my business, I'm going to buy it in my S corp. But with that comes a lot of hidden tax pitfalls associated with
Well, and
it.
to your point too, Letty, right? Is like, don't go out and buy and then have that conversation with your CPA 2 months later, like, hey, this is what happened. So here we are. It's like, no, have that conversation before we actually buy it, right? So you're planning ahead, like you talked about.
When somebody's buying a medical office building and maybe they're going to occupy, let's say, half of it, or maybe less than half of it, and they have all these other units, do they need to be going for real estate professional in that situation to be able to use it to shelter income, since there's so many other tenants, or does it matter in that case?
I think it's going to depend on their situation. I mean, they certainly could if they have other real estate that, they're close to being a real estate professional, that is one option. The other thing we've seen done and what we've done with clients is, let's say your medical, you know, office is taking up 50% of the building and the other 50% are other tenants. What we'll do is we'll separate those two activities on the tax return. So you've got two rentals now instead of one. One rental is actually grouped with the S corp activity, and the other one's just a normal, quote unquote long-term rental. So that's another way to do it for the people who are not going to be a real estate professional.
Okay, beautiful. Yeah, we've seen we have a recent example. We were talking to a pediatrician, and she's actually building an empire of medical office buildings and had her husband do real estate professional. So she's going and buying multiple medical offices, not working in them, and now grouping them and sheltering the income from the first one with all these new ones. So the grouping election. Yeah, perfect.
Will say we do see the grouping election kind of in the reverse too. A lot of times, physicians are a lot of times are good about investing, right? Wealth building, investing. So we have a lot of physician clients who just have already invested their money in different things. So, maybe a doctor investing in an assisted living home or in a nephrology center, right? And what we've come across is a lot of CPAs will automatically group these to be active. So I think that's a first reaction is let's make everything active. But sometimes the reverse is actually better, right? If you're a doctor who has other rental losses or you've invested in syndications that have these passive losses, if you're not a real estate professional, we can't use it. And so if we're grouping these other investments as active, then maybe we're also not able to use it. But if we just shift it so that, hey, maybe I am not involved in these investments of assisted living and nephrology center, if those are passive, then I can just use my rental losses against it. I don't have to worry about being a real estate professional. So that unfortunately is something that we're seeing more frequent than we would like. It's always begs the question, like, who is looking at these K1s and trying to get the answer of should it actually be active or can it actually be passive?
Yeah, we have an example of a nephrologist who, when they started investing in real estate, because they had passive income coming from a dialysis center, they didn't want real estate professional. They were wanting to buy long-term rentals and take the passive losses and shelter the passive income from their dialysis center. So I love that. Early on, we had somebody, a CPA, tell us that why are you trying to increase your active income? Try to increase your passive income. And don't worry about reps, try to increase your passive income and then offset it with passive losses from real estate. So just a different way of thinking about it, I guess.
We had a similar shit. We had a client come to us said, I think he was, it was dialysis center, something like that, but it was basically like a 7-figure K1. And he came to the, tunnel vision. I've heard about real estate professional. I want to be a real estate professional. It's like, dude, you don't need to be a real estate professional. Like, just go out and invest in syndications. You still have your W2, you still get your own practice. Yes, but let's start by offsetting that $1 million of income first, and that was a game changer for him for sure.
Mm-hmm.
What have you guys, how do you guys feel about this strategy, which we've just offhand heard about, where you actually take your medical office, let's say you're actively working in it, but you hand it off to your kids over time so that you become more passive because they're the owners, right? And so now it's passive income. Have you guys ever seen anyone actually do that? And what do you think of that kind of strategy?
I don't think it's a bad strategy. I think we don't really see that often. And I think it's in looking at more longer term planning. One of the biggest benefits in the tax code is that we get step up basis when we pass away, right? Which means I buy a medical building for $1 million. When I pass away, it's worth 10 million. My kids get to inherit that and nobody pays taxes on that $9 million appreciation. One of the issues with me starting to give ownership of real estate to my kids now is that they will no longer get step-up basis. So again, not to say that's a bad strategy, it's you just have to look holistically to see if that makes sense. If we're talking about a taxpayer who's over $26 million of net worth, then that could make sense to put that in some kind of irrevocable trust or just start gifting it now. But if you're below that threshold, we just have to look at what is the cost, what's the future cost of doing that, right, for immediate savings.
I think a similar question comes up when you're talking like succession planning. So not just transition the business to or real estate to the kids, but maybe you're transitioning the business to a new owner. And maybe you still have partial ownership, but you're kind of dwindling your hours, right? You're in 50s, you're starting to retire. So a similar strategy, people are like, hey, I'm not working 2,000 hours there anymore. I'm not maybe making all decisions anymore. So this is really that passive activity to me, right? Well, unfortunately, the IRS has this kind of look back period. So that strategy can work to kind of convert you're still getting a K1 from the practice to passive income, but it's got to be more like in forward thinking where it's year 6 or 7 where you kind of get outside of this look back period where the IRS says, hey, no, you were still active 5 years ago or the last 5 years. That's still an active activity for you.
Hmm.
So we talked about the grouping election and using that for medical offices to offset W-2 income without real estate professional status or the short-term rental tax loophole. This next one I wanted to bring up is not really a strategy necessarily, but it's when somebody purchases a property and accumulates suspended passive losses. In other words, they don't have real estate professional. They have these losses that they accumulate over the years. We ran into a dentist one time. They had $1 million in suspended passive losses just sitting there. And what happens is that when they go to sell the property, we understand that those suspended passive losses actually can offset active income at that point. So can you talk a little bit more about that?
Yeah. I mean, when you sell, and this is the issue we always have with CPAs who say, don't invest in real estate because you don't get any tax benefit, right? When people say that, they're just looking at on a tunnel vision, like you can't use real estate to offset W-2 today. But what you described is a really great example of how, okay, over time, when we have these accumulated passive losses, eventually when I sell the property, all those losses are freed up. And when they're freed up, they offset all types of income, not just rental income, not just passive income. It offsets W-2 and all sorts of other income. And this is true regardless of whether you're a real estate professional or not. And so I think this is really important for any of our listeners who are like, I don't even know if it's worthwhile for me to do tax planning or capture my expenses if I'm not seeing a current benefit, because there's always a future benefit. And the future benefit, like you said, if it's $1 million offsetting a dentist's income from their business or W-2, that's going to be very, very significant.
In that scenario, is there a depreciation recapture?
The depreciation recapture would happen whether if you have when you're calculating the actual gain or loss on the sales price minus the basis, but the suspended losses can offset if there's depreciation recapture, can offset other income. So it's the losses that are tied to that property that you're selling, those can be released. I guess the only caveat there that one caveat I can think of is that this is assuming it's a normal taxable sale, that you're not doing like a 1031 exchange or a like kind exchange or something like that. But if you're just going out and selling the property, like, hey, maybe it didn't perform as well as I want, I'm looking to move my money somewhere else, I'm just going to sell the property. If you've got a couple $100,000 accumulated there that you haven't deducted yet, then we can deduct it in the year of the sale.
Another mistake we've seen made by CPAs is the treatment of the losses. Because when we sell rental real estate, if it's a gain, we pay capital gains taxes. Mm-hmm. And so sometimes CPAs don't know. And so when you sell a property for a loss, they'll treat that as capital losses. And for tax purposes, capital losses are not as good, right? Because we can only offset capital gains income. So really, really important to understand that when you sell rental property, in a worst case scenario, we have capital loss, we have passive losses. All of those losses are ordinary losses. They're actually not capital losses. But that's sort of a confusion area we've seen from time to time.
Mm-hmm. Awesome. And then one other thing, we've been talking about the grouping election, and I wanted to touch base on what if you had grouped your property that you're selling with other properties and you sell that property, what happens in that situation? I understand that the grouping maybe doesn't allow you to use those suspended positive losses to offset income at that point.
It makes it challenging because the kind of the terminology the IRS uses is like you have to sell substantially all of the asset. And so, if you've got a grouping of 5 properties and you're selling one, that probably clearly not substantially all, but if you can make the argument that you sold 80% of it. I've seen some court cases or, colleagues that kind of make that argument that, hey, this it's got to pass that threshold at least, so some give and take, but it depends on the facts, I think.
Yeah.
And this is so interesting. I think that's what makes taxes fun is,
Fun. See, this is fun.
It's
It is.
if you're
fun.
someone, I think we tend to think like real estate professional is the best strategy. Let's group everything together and be a real estate professional. But here's a great example of maybe why it would not make sense, right? It's like, if I'm a real estate professional this year, I have to group in order to achieve it, but I'm going to sell a property next year that have all these accumulated losses. So that's where you have to look at the numbers and say, okay, which one is actually going to give me a better benefit? And they'll help you decide, do you group that property or do you exclude that property in your grouping if you're going to be selling it soon?
This just makes me realize also, we have a short-term rental where we did the short-term rental tax loophole with the 100 hours and more than anyone else. And so we didn't group it, with our long-term rentals. Kenji did, obviously real estate professional for the long-term rentals, but it was kind of its own little thing. That first year we were active and then we were passive, and now we're selling it. If we weren't 1031ing it, it was never really grouped with any of our other ones. So we could actually capture any sort of losses that we had, but we did 100% bonus depreciation. So
we took the losses the first year.
yeah. And we had
so no losses.
Yeah, but it's cool to just think that short-term rentals and long-term rentals really are separate too. So people need to be mindful of that too, because when you're grouping for real estate professional, because we do have some people who will use the short-term rental tax loophole, and then they'll also do real estate professional, but they're separate buckets because you're not grouping them together. So it's important for people to remember that.
Yeah. It's taxes are so confusing. People are like, why are there 2 different rules?
So we talked about disposing of an asset, how you can use those losses to shelter income. But what about partial asset disposition or partially disposing of an asset? Or I guess we're talking about getting rid of assets. Maybe you can explain partial asset disposition first. But what about in that situation? Can you use the losses from that to offset income?
Yeah, that's a really great question. What we were just talking about is disposing of a property, right? Selling a property, for a lack of a better term. So when you sell a property, you free up the losses associated with that property. But usually in the tax world, when we use the term partial asset disposition, we're not talking about selling a property. We're not talking about selling part of a real estate. That's not really a thing, right? So partial asset disposition just means that, I am replacing an asset that's used in my real estate. And so I'm going to dispose of it for tax purposes because I no longer have that. So common example would be I got a whole new roof on my property. And so I'm going to depreciate the new roof. I'm going to do a partial asset disposition of the old roof because that's gone. It's been like torn off. So that's what partial asset disposition typically means when it comes to taxes. And that's different than like selling of a rental property.
So yeah, it just kind of means you're deducting the cost basis of the old roof, right? You're writing it off now because it's gone, right? Now from a tax treatment perspective, the tax treatment does follow kind of the treatment of the rental property itself. So if you are a real estate professional or you're doing this in your short-term rental and you're using the short-term rental loophole, that disposal of that partial asset can be an active loss. But if it's a passive activity, then the loss, that disposal is still going to be kind of in that passive bucket. So it just kind of depends on if you have other passive income in that situation.
Can we use real numbers? Let's say that I just buy a property that has like a 20-year-old roof, and the first question is, what would you say the value of that roof would be when I bought it? It's a 20-year-old roof, but I just bought the property. So don't I get to depreciate the roof right from the beginning again?
I mean, that's what the cost segregation is for, right? We don't know what the value of the roof is, and the value will differ from property to property. So what happens then is you'll get a cost segregation done. They'll break out all the different components. And so eventually, let's say in year 2, replace the roof, then you just get rid of the original roof that was partially broken out. Now, there are times where maybe it wasn't broken out. Maybe you didn't do a cost segregation. You're just wanting to put on a new roof and you dispose of an old roof. IRS has a couple different methodologies for you to calculate what is the value of that. So it's not necessarily a requirement that you get a cost segregation done, but for most of our clients where like this matters, they usually would have gotten a cost segregation. So it's easier to know how much is being disposed of in that partial asset disposition.
Okay, so let's say the roof is the cost segregation says the roof is valued at $20,000, and then the next year, like you said, you replace the roof. So it's only been depreciated for a year, and so it would be a little less than $20,000. And are you saying that in the second year, when you do your taxes, you can actually write off 20,000 or a little less than 20,000 at that point? Okay.
Yeah, it's like selling an asset. So you put on your, whatever, form 4797, dispose of it. It would be the 20 grand minus whatever depreciation you've taken on the property over that first year. And then you start depreciating the new one. So it's kind of it's almost like a double benefit to some extent, obviously.
Mhm.
Yeah, I call it double dipping, but it is really a great idea. At least in our community, what we often do is we'll buy a property, we'll do the cost seg study up front, then we'll do the rehab, and then we'll have the cost segregation company, give us another form, basically another cost seg study. Not, obviously having somebody go to that site, or our CPAs can do it, right? How do you guys decide? Do you have the cost segs company often do it, or do you guys like to do it? How do you approach that?
Think it depends on the scope of the rehab. If it's a significant enough rehab, usually you'll get a different cost segregation done. They call it an improvement cost seg, right? So I spend another $400,000. Let's get an improvement cost seg on it. If it's something pretty small, usually we just do it as part of a tax return, as long as the client can provide us like how much money they spent, what they did. Another tip I usually tell clients is if you're kind of in the middle, it's not a very extensive rehab, it's not like super tiny. Then what you can do is try to work that into the pricing of the cost segregation, right? Just to let them know, like, hey, please come and take a look at my properties and start the cost seg now. And I'm going to come and start tearing down and making improvements and then finish the cost seg when I'm done with it. So they can include it all as the scope of one rather than having two. For cost seg firms, usually if you tell them that upfront, they're pretty good about it. If you tell them, after they've issued the report and you come back with, hey, here's another 100,000 I spent, usually they're going to want to upcharge for that as a second scope of work.
Now, isn't there a downside to partial asset disposition? Because if you, let's say that you buy a property for 500 and the roof is 20, isn't your new basis 480?
There's no real
Did that not make
difference, right, in terms of like cost segregation. Same thing, right? If I bought something for $1 million, I did a cost seg on got 300,000 write off. My new basis is 700,000. So it's the same exact concept. Which is just, with depreciation, I'm not creating new bases. I'm not creating new deductions. I'm simply accelerating my write-off, right? So maybe a partial asset disposition might be detrimental if you're gonna sell.
But you've also bought the new roof, right? So your basis is going up because of that, right? So
I guess generally too, the new improvements will cost more than the partial asset disposition you just did. I don't know that I've seen the reverse, but it's usually works out that way.
Makes sense.
Okay.
Makes sense. Okay. Anything else we didn't ask you that we should have about how to shelter W-2 income, 1099 income, business income using real estate, but not having short-term rentals or not having the short-term rental tax loophole or real estate professional?
I think we touched on a lot of them. We talked about, using those suspended losses when you're, releasing those suspended losses. That also works like if you've got suspended passive losses. Your investors probably know this, right? But then you sell some other property, right? That's got a big, large capital gain. They're like, I don't want to pay tax on my capital gains. So I was like, well, you've got all these passive losses sitting over in this bucket that are waiting to be used. That's a great way to use them, offset. So that can work in situations like that too.
Yeah. Offsetting W-2 income without real estate professional status, another one we work with our clients on. That probably could be a whole hour long session, but with charitable planning. So we have clients where, they're not going to be a real estate professional. They're very charitable minded. So you can set up a charitable trust, put one of your rentals in it, pledge that you'll donate the cash flow of that property for the next 5, 7, 10 years. And in exchange, get an immediate upfront deduction on the future pledged donation. So that's worked out pretty well for some of our clients who, are not even real estate professional. And the reason we don't care about real estate professional is because it's not a rental deduction. This is a charitable deduction. We're just using real estate as the asset class. But it's even more powerful for clients who are real estate professional because you're sort of double dipping, like what Leti called it, right? I'm taking the bonus, I'm taking the deductions, and on the same property, I'm getting a charitable donation deduction for future income I'm going to be donating to. So
yeah, that can work well for people that, like they've got a practice. They're not buying the rental properties necessarily for cash flow right now, right? So whatever future cash flow they're going to get over the next 10 years from that one property, they don't need the money per se. It can work really well in those situations where they're okay giving out away to charity.
Yeah, because I think what people really love about that is at the end of the trust term, the asset comes back to you, right? You or your kids or your beneficiary. So what you're parting with is just this pledged cash flow donation, not really the asset. Because I think for most of our clients, they want the asset. That's their legacy. They want to leave that to the kids and grandkids.
That's a cool strategy.
Yeah.
Yeah. We'll have to look into that. Another hour episode in the future.
For those who have never gotten to hear about what you guys do, can you talk a little bit about Keystone and your tax course and how people can find you?
Yeah, so our specialty, I guess most people come to us because they either already invest in real estate or want to use real estate as one of their main wealth building vehicles. And so what we specialize in is tax planning on how to use real estate to pay less tax, whether it's just W-2 income or just other passive income. And so we have clients nationwide pretty much. And we have different services for people depending on, where they are in their investment journey. And so the best place to find us is just go to our website at keystonecpa.com. We have a lot of free, great resources. And you can also schedule a consultation with our team to find out if tax planning is right.
And we'll put a link below for your tax planning course for people as well. And then you've written a couple really amazing books that I tell people to read all the time. Tax Strategies for the Savvy Real Estate Investor and Advanced Tax Strategies. You guys should all read them. You will get really excited about taxes. Like we were saying, taxes are fun. And especially after you read those books, you'll remember that they are fun. Thank you guys so much.
Good nighttime reading,
Yeah, absolutely. And for people who want to hear more from you guys, they can come to the Prosperity Conference too, which we're hosting in Las Vegas in March of 2025 and get to meet you in person. I'm excited about it. Actually, I don't know that we've ever met in person, so this will be fun.
Slow down. So it's a lot to digest. I think you're right, but
That's weird because we've known you forever.
I know.
So we'll just pretend like we don't know you when we see you.
That's right. That's right. Okay, thank you guys so much for your time.
Thanks for having us, guys. That was fun.
Thank you.